Welcome to this short video, and we'll just be reviewing some of the concepts that probably are misunderstood in the money management industry. And this basically has to do with the mutual funds. And when you are thinking about the mutual funds industry, let us first of all just think of it in a rather simple without complicating it too much. So what is a mutual fund? Picture just a basket of stocks that are meant to track certain benchmarks or certain indices. For example, let's assume that I want to track a certain index that looks at the economy generally, and this index over here, or this product, financial product, looks at industrial stocks. So if I'm going to create what we call a mutual fund in this case, what I'll probably do is just try to create stocks that mimic this kind of behavior. In other words, if the market index goes in this direction, you have my mutual fund just around here, or even outperforming the industrial index that I am looking at. So this is a bit different from what you call inverse mutual funds, where as the market is falling, the value in these funds is rising, or even hedge funds, which have positions on both sides and can be directional in some cases. So when we're thinking about mutual funds, it always seems like the safest bet for most people. If anything, if you've been told to start investing in the financial markets, there are two products that they always suggest. The first product are what you call the fixed income unit trust or products, because they're very secure. Your capital will be intact, and most of the times they give something decent between 1% and 1.5% in some cases, but annually you're probably going to get 12% to 12.5% on the max. This is very good if you're looking at a very large account, whereby 1% per month accounts for a lot of money. But if you're looking to make money in another way, it may not be advised for guys that are holding small accounts. The next kind of investment is the mutual funds that actually supports the passive investors. This is the investor who is not interested with just active investing, looking for signals, looking for markets to buy, looking for trade ideas to be able to invest their capital in. It is more or less what I call a buy and hold, because the only thing you do is source and analyze your prospective mutual fund manager, look at the track record of that mutual fund manager, and then you invest your money in that fund. But is it always that easy? The reason why I say mutual funds do bear some level of risk in themselves is because of what actually happens. Now, consider this, several things. A mutual fund manager is not paid to make you money. If anything, they are paid on commission basis for only outperforming the index that we talked about here, this index. They are only paid to outperform. What this basically means is they are not paid to help you to make money. If you give them your 100,000 or whatever savings you want to give them, their interest and your interest are in conflict, because if they lose money, nobody's going to cost it on them. If you lose money, nobody's going to actually sue the mutual fund in that case. Of course, there are some cases where there have been court cases over the management of the mutual funds, but in reality, they are only paid to outperform the index. This means that if the index performed at 10% and the mutual fund performed at 11%, you will have to pay them. The inverse is also true. If the index that we are benchmarking ourselves against loses 5%, but this fund only loses 4%, in some cases you will have to pay them. But note, this is actually 4% loss on your account. You have actually lost money in this process, but yet you have to pay them still. This is a serious flaw from what people know about, because you always assume that the reason why I'm giving you my money is, first of all, to secure the capital, and secondly, make money out of it and charge me out of that. But in this case, even when I am losing, I'm still getting charged. That is one flaw that most of the mutual funds always face. Now, if you go to the other flaws that most of these mutual funds will experience, one in particular that is that most people actually never really get to know about, because again, most of the mutual funds retail traders or retail investors are not very keen on these details. They do not follow up on these details. One of these errors is what you call the survivorship bias. And when I am talking about the survivorship bias, what I am referring to here is, if you look at the history for the last 50 years in the mutual funds industry, what you will find is that there are some stocks which have intentionally been deleted from the basket because they are performing poorly. In other words, there's a research which was done, or there's a book that probably I advise you guys to read. It's called Random Walk Down Wall Street. And it showed that 15% of funds were dropped out between 1988 to 91, the year. What this means is that if we had kept the stocks within that fund, the performance that we'll be looking at would not be that significant. We would not be looking at exaggerated figures. Therefore, if we remove those stocks and replace them with other ones, you are looking at an exaggeration of about 2% per year. Now, this may look insignificant, but if you stretch it to a period of 10 years, you're looking at a very significant number. So you'll be fooled to think that the mutual fund has been performing very well, but in reality, this is being stretched and is a data error to begin with, because some of the stocks have been removed from that fund. Now, this is no small thing, because it has been used in court cases where mutual funds have been sued for actually misrepresenting their actual performance. Now, let us just look at another way that these mutual funds misrepresent what exactly they are doing, so that most of the guys end up picking the wrong thing, or end up making poor investment choices. And this error is what we call the instant history bias. And in the instant history bias, what we are talking about here is very simple. If you take the whole lifetime of a certain mutual fund, you have up times, down times, volatile times, and quiet times in the whole time horizon. But when some of these funds are being marketed to you, the retail investor, they will actually start with the bottom line. And what I mean by the bottom line is, they'll start off from a low point and then show how the fund has been performing in this direction. And what they are doing is they're using this as the reference to anchor your thinking, and you erroneously assume that the fund is actually going up. Well, in reality, it may be something that looks like this. The fund is actually dropping in value over here if you take a longer time horizon. If you look at the longer time horizon, you'll be noticing that this fund is actually in a downtrend. But if you start from, maybe let's start year 2015, this may look very promising. It may look very promising, and you might even invest in this fund, and you will forget, if you go back to the year 2000, this is exactly what is happening. You are looking at a falling fund. So be very, very careful when you're thinking about mutual funds and the time horizons that you've been presented with. Most of the time, you do not get all the data, but in the current technology age, you can be able to get all this data for the whole life of the fund to be able to gauge, is this a falling fund or is it a rising fund? And then again, if you choose to invest from this bottom line low point, you can be able to do that by fully well knowing that you are in a bearish fund. You're actually investing in a bearish fund that is just recovering, which could also be just a simple retracement before we continue going down in the years to come. That is one way that most of these mutual funds will always misrepresent what they're doing. Another way that most of these funds will misrepresent exactly what they are doing is by something we call the new manager bias. And in the new manager bias, the concept is really simple. Most of the funds will always get an influx of money when they change the manager, but with a caveat. You only take the data from that manager from the good times and not the whole time horizon. So if we add a manager called G.CHEGE over here, and we know they have overall, in the overall time they've been wealth managers, they've been losing, but for the last, let's say 2 years or 3 years, they've been performing very, very well. Then we start advertising this new manager starting from the 2 years. We do not go for the whole time period, and this in a way acts as a blinder to the person. You actually assume that the manager is very, very good, but when you look at the overall performance of that manager, they are very, very poor. Now, all these things over here act in a way to blind the investor to making investments to mutual funds that are actually poorly performing mutual funds. And when you think about, if assuming that you want to buy mutual funds right now, you're talking about a buy and hold strategy that is very, very good, especially given the current market rally. But it may not always be the case. It may not always be the case. It may not always be that the market will keep going up, keep going up, keep going up. It may not be that the best mutual funds are the ones to invest into. So it calls for due diligence. And some of the things that you need to look out for are this. What is this fund that you want to invest in tracking? And how has it been performing? That is the first thing. Now, the second thing you want to look at is, has there been any stocks removed from that overall fund? And why was that the case? And the second one is the mutual fund investment manager starting from a low point that actually shows the performance to be this, when in reality you're looking at this. The other thing is, who is the manager of that mutual fund and what is their whole track record? In other words, since they began investing in the mutual fund industry, how well have they been performing? These are just a few of the things that I think, and I am persuaded, that are very important for the retail investors, because most of the things that you find out there are misleading. For example, if you're looking at the mutual fund industry, you'll find that the institutional traders or the institutional customers and the retail investors get different cost structures. In other words, the institutional one gets cheaper structures while the retail gets more expensive structures. Therefore, if you're going to overcharge me to invest in your fund, it better be that you help me to make money. And in summary, therefore, you always want to have a fund that is performing well over the years. That is the first thing. A fund that is not misrepresenting how it's being managed, and a fund that is actually not in any way trying to misrepresent the kind of stock structure in the basket. These are important factors to think about when you're looking at the mutual fund industry. So I hope the video was informational or educational. Thank you guys for watching.